We just sold our investment property and we're going to share everything with you. Now, I love these types of videos where people break down real numbers. I'm actually going to show you guys our settlement statement and what we sold the Baby Queenslander for here in Southeast Queensland. We're going to go through all of the associated expenses and the actual money we ended up with after all the costs from the sale of our investment property. Now, let me give you a little bit of background about this investment property. We purchased the Baby Queenslander at 25 Leach Street in Everton Park, roughly 7 kilometres north as the crow flies from Brisbane CBD. Now, in April 2020, the property market had gone through a turbulent time. Lockdowns had just begun here in Brisbane. The property actually had its open home cancelled, and we made an unconditional offer on the property of $536,000. The property was being sold by the public trustee of Queensland and was a deceased estate. So unfortunately, the original owner had passed away and now it was being sold by the public trustee. They had a list price on the home at $565,000, which is a lot of money for a two-bedder on the north side of Brisbane at that point in time. But for us, we saw the value in the land and the location, and we took a long-term investment horizon over a 5 to 10 year period that we were planning on holding this property. And so that's why we were happy to jump in and make an initial offer of $536,000. After some back and forth with the sellers, we agreed on a sale price of $544,000, and we were very excited. We had an unconditional contract, and now we just had to wait for settlement. Now, we received settlement confirmation on the Baby Queenslander on the 3rd of June 2020. And that is almost 4 years to the day now that we bought that property. Now, this was actually the first proper renovation that Emily and I had ever done on an entire home. Before this, we bought our very first property and we'd done some renovations, but we'd also outsourced some of the work. Now, with the property at 25 Leach Street, we got stuck in. We got our hands dirty, we sanded the floors, we bought a paint sprayer. We absolutely had some mistakes throughout that renovation process, buying wrong and cheap paint and having to redo some of those jobs. But we learned. It was one of those renovation projects where we got stuck in, we refurbished the kitchen with what we could work with, we refurbished the bathroom, painted up the home and sanded up the floors. Now, the initial rental appraisal at that point in time was around $350 to $380 per week. But after conducting the renovations, we were able to achieve a rent in the low to mid 400s, getting rent roughly around that $400 to $425 per week. We spent around $35,000 on the renovations, and we did keep everything on a tight budget because we did so much of the work ourselves. Given the property rented out for roughly around $450 per week and then eventually was increased to $480 per week before its final lease ended on the home, we were getting around a 3 to 3.5% gross yield on the property, which means it was negatively geared. Now, with the lower interest rates, it was roughly costing us around $10,000 a year to hold, and with the higher interest rates, that was looking upwards towards $20,000 a year in terms of holding the investment property. So we purchased it for $544,000, spent about $35,000 to $40,000 on the renovations, and that's when we went back to the bank and got a reevaluation, and that allowed us to continue building our property portfolio. Not only was the transformation of the home exciting, the financials were really what mattered to us in our property portfolio moving forward. This property allowed us to leapfrog into the home I'm standing in today, and also the sale proceeds have gone into this major raise and build project, and that's exactly why we sold the property. We were actually planning on holding the Baby Queenslander for a 10-year plus period. It's located in Everton Park, which is a blue chip suburb on the north side of Brisbane. It's on 607 square meters, so a really good sized block. Yes, it's a smaller home, but it's in a fantastic location. But given we're looking for some lifestyle and we're looking to upgrade the family home and we've got 2 young boys now, it made sense for us to sell that investment property, realize the gains and spend the money here on our raise and build project. Now, if you want to see the sales walkthrough of this property, I'll leave a link at the end of this video, which you can click on, but let's not stall any further. How much did we actually sell the home for? After listing the property up online, we achieved a sale price of $963,000. Now, this was above our expectations for Emily and I. We had thought the mid 900s was where the property would potentially land, and we were planning on running a 3-week campaign to get as many people through the home as possible, as many offers on the table as possible, and to achieve the highest sale price. So what ended up happening? Well, we did our first open home and we had so many groups come through that we actually received over 10 offers from the initial open home. We made it clear to the buyers that we were willing to accept an offer because we had provided a building and pest report to the potential buyers. And so if people were willing to make an unconditional offer on the home, we would sell prior to waiting the full 3 weeks of our sales campaign if we got the right money. Now we had other offers around that mid 900s as well, but they did have finance clauses or they weren't as sharper terms. And that was that. So let's take a look at the settlement statement and break down the real numbers for you. So on screen, you can see a real life settlement statement. If you've never sold or bought a property before, this is what your lawyer should give you once the property settles. It'll break down your side of the equation in terms of the sale proceeds, where the money has been sent, and how much money you're going to end up with in the end. So you can see here the contract price on the property was $963,000 and the buyers paid a deposit of $10,000. So that means for settlement day, we needed to get $953,000 together to settle and buy the property for these buyers. So we have some other costs involved when you buy and sell a property. So there needs to be a release or a discharge of the mortgage. Banks are always going to hit you up with these little fees here and there because that's how the banks make their money. So the bank charged $224.32 just for you releasing a mortgage and then filling out a piece of paper. You also need to pay your council rates. So they do an adjustment based on the period of ownership and who owns the property at a certain date. Same with water and sewage. They again apportion it between the buyer and seller based on the days that you own the property. So $117.60 for water and sewage, and then they less the water usage of $9.69. So taking into account those things, we had a reduction for the mortgage, add back the council rates because we got a refund for some of the fees we'd already paid, less some of the water and sewage rates and the water usage, leaving a balance due to the seller at settlement of $952,951.42. Now, that would be amazing if I got $952,000 straight into my bank account, but we used the Commonwealth Bank of Australia to finance and purchase this property. We also drew up on the value of this home at least 2 times to make future purchases. The first time we drew up on 25 Lee Street was to buy this home, and we purchased this home for $681,000 and drew out roughly about $60,000 to $70,000 from the Baby Queenslander when we did that refinance in 2020. We then also drew out another about $200,000 to $250,000 a few years later to buy our unit block in Coffs Harbour. So that actually significantly increased the debt secured against this investment property, and I'll show you those numbers right now. So as you can see on screen, they split that $952K up in 5 different ways. PEXA take an admin fee, so $132.66. KRG Conveyancing take a fee of $566, so they were our conveyancers, so we need to pay them for their services. Queensland Urban Utilities gets paid out what they're owed for water and sewage. CBA, that's the debt that we're talking about, $617,683.46. Now, if you actually looked at the screenshots from our bank account, our actual debt was about $615,000. So what's happened is the bank's tacked on about another $2,200 for the settlement of this loan. And these are just fees you have to pay when you buy and sell, which is why when you're buying property, you should be taking that long-term perspective because there are significant entry and exit costs when it comes to buying and selling property. We then cleared $334,190.16. And this is just a calculation below for the water usage at $9.69 for a certain period of time. So did we actually clear $334,000? I think there may have been a few more costs that we should have a look at in a Google spreadsheet to give you the real number of what we ended up with, and then I'll reveal to you what we're actually doing with that money. So as you can see on screen, we've got $334,190.16 straight out of our settlement statement and plonked here into our Google spreadsheet. Now we need to just take out our additional expenses to get the net sale proceeds that actually ended up in our bank account. So the first expense was staging. We used a company called Sell and Style. They set us back around $2,700 for the staging of the home. And I think it made a really big difference to give people a perspective of what the home could be and how you could potentially live in the space. We used an online platform called Property Now, and that cost us $800 to put the property up on realestate.com and to put it up on Domain and to get the most eyeballs on our listing. So we had 30, 40 groups come through and over 10 plus offers on the home. Some offers were as low as $800,000, which is way below market value for the property. And we had multiple offers in the mid $900,000. So there was a really big range of offers in the 10 plus offers that we received, but we ended up going with an offer that was unconditional and right up there pushing in terms of price point. We also had to pay for electricity for only a few weeks on the home. That set us back a monthly fee of $99. Now this is important when you're selling a property that you do have the electricity on, so people can flick the lights on, your stages can use the lamps and things like that. So it was well worth paying that little fee. We also have some signings, so we used a open home sign, which set us back about $80 from Vistaprint. We had the exterior pressure washing. That was so well worth it. That was $660 and just really spruced up the outside of the home. And we had some photography, which set us back around $280 for a floor plan and photos of the home. So all of the additional expenses were $4,618. And this leaves us with net proceeds of, drum roll, please, $329,572.16. Now, hopefully that is transparent for you. I probably can't make it any more transparent than that. Revealing the address to you, revealing the exact proceeds, revealing the debt on the property, and what we've ended up with at the end of the day. Now, you need to take into account that negative gearing. So we've probably plowed in something like $10,000 to $20,000 a year in terms of negative gearing or forced savings into the home to cash flow it and to hold that property over the last 4 years. So even taking that into account, we've probably cleared around $300,000 profit on the property. Now, you also need to take into account capital gains tax. Now, for Emily and I, we get a 50% CGT discount because this is an investment property. So take that gain of roughly, say, $330,000 and divide it by 2, and that gives you what we're going to be taxed on. Now, Emily and I owned this property 50-50. So you then divide that by 2 again. So let me show you those numbers on screen. So as you can see on screen here, if you divide 329K by 2, you'll get $164,000 tax-free. We are then going to be charged capital gains tax on $164,000. What that means is because we own the property 50-50, that's going to end up in each of our tax returns. So we're roughly going to have $82,000 in each of our tax returns for financial year 2024. Now, this is what happens. Your capital gains tax flows through to your marginal tax rates. Now, there are going to be some adjustments in this CGT calculation, which we're not going to go through today, but it gives you a good idea of how we end up with the net proceeds and what you're going to end up paying tax on. Now, assuming we had no other income in our tax returns for the financial year 2024, we would need to pay $19,100 each based on $82,000 going through each of our tax returns. So the total tax on this potential sale could be something like $38,000, or if we have other additional income during financial year 2024, then obviously this tax will go up based on those marginal tax rates. So what lessons have we learned and what are we going to do with the money moving forward? I think the biggest takeaway with this investment property was focusing on growth was the right strategy for us in building out our property portfolio. If we bought a cash flowing property and focused more on yield, we wouldn't have been able to build our asset base. This property at 25 Leach Street allowed us to leverage multiple times and create value through a renovation strategy as well. So the property was able to be lifted in value both through manufactured value and capital growth, and allowed us to leverage and build our asset base to over $5 million. We also learnt heaps on the renovations. We learnt how to use paint sprayers, how to sand floors, how to tile for the first time. So it was priceless in terms of those learnings because we never had the opportunity before to take on those types of projects. Now, what are we going to do with the $300,000 moving forward? In actual fact, the money has already been spent, would you believe? This major raise and build project here in Southeast Queensland in our family home has cost a lot of money. And we're going to be giving you guys a full renovation series this year, which I'm very excited to share with you, and it's in the works right now. So we've actually spent all of that $300,000. It's already gone on raising the house, on carports, on sheds, on swimming pools, on upgrading this family home for myself and our family. And I think that is money well spent if you ask me. Yes, it's a very expensive venture, doing a major raise and build project, but we're going to get the money back by being able to refinance out of this property down the track, and we get to enjoy this beautiful home, and I get to have the YouTube studio, and the kids get to have some space. And so we are going to make the most of our family home. I hope you guys really enjoyed the transparency in this video. We try to be as transparent as possible. And yeah, if you could do me a huge favor and drop a like on this video, that'd really help me out, and subscribe to the channel down below. If you want to go back to the very beginning and see all of that renovation series on the Baby Queenslander, then make sure you click this playlist over here. Thanks for sticking around. I'll see you in the next one. Peace.